I think it's important to take a step back and kind of take the context of yesterday, also last week, and really the last actually 9 months. You know, the market basically has gone sideways for 9 months, right? It peaked in January, fell 11.8% on an intraday basis. It came roaring back in recent months, actually made a new high at about 29.40 on the S&P, and then last week, of course, was a pretty violent sell-off, and then yesterday it came back. But when I put the pieces of the puzzle together, it really paints a story where, you know, there are cross currents, and generally when there's cross currents, the market doesn't make a lot of gains. And the cross currents are that, you know, earnings, as we know, are growing very strongly. They're booming, but they're also probably peaking here on a rate of change basis. So certainly not on a level basis. And interest rates, of course, are rising. The cost of capital is going up. And when you combine those two factors, you know, they make up the numerator and the denominator of the discounted cash flow model. And, you know, the perfect scenario is where earnings are growing and interest rates remain low. That causes PEs to go up, and against the backdrop of rising earnings, it makes prices go up a lot. And that's basically what we've seen until this year. So really the Goldilocks scenario. And this year we're seeing something a little different. It's not the end of the world by any means. It's not a bear market. But the cost of capital is rising, so the denominator is now offsetting the numerator at a point where the markets and investors are worrying that maybe the best is behind us in terms of earnings. And I think last week was a little bit about that. You know, we had a few kind of publicized misses on the earnings front in recent weeks, or lower guidance. And I think generally people were worried that, okay, this is as good as it's going to get. And I think some of the earnings announcements over the last couple of days have you know, alleviated those fears. But we'll have to see how third quarter earnings season comes out, because if there are concerns about, you know, trade, for instance, or rising labor costs, we should probably start seeing those come out of the earnings releases. And I think that's kind of where people are holding their breath. And I think yesterday was a sigh of relief that so far that isn't happening, and that earnings are actually coming in very strongly yet again at around 20%, with over 80% of the companies beating. But, you know, this week, next week will be huge weeks in terms of the number of companies reporting.
Jurrien, is the U.S. strength of the economy, is the U.S. strength of the earnings picture, is the U.S. strength overall enough to keep global markets buoyed or at least stable in the coming weeks and months?
You do need the global economy to follow suit, and of course China is very important. You know, Europe is doing pretty well, Japan's doing very well, but the Chinese economy has slowed. You know, China just lowered the reserve requirement ratio yet again last week, I think it was, by 100 basis points. And the problem with China, of course, that the economy has slowed. It's still growing. I mean, it's okay, but it has slowed. And of course, China, with its currency linked to the U.S. dollar, essentially is importing U.S. monetary policy. And of course, U.S. monetary policy has been on a tightening mode, or a normalization mode, as the Fed would call it. And so there's a conflict there. And that speaks to the larger divergence that we see globally, where the Fed is tightening, the ECB, the Bank of Japan, the People's Bank of China are all still in easing mode, although the ECB, as we know, is trying to sort of get to the exit on its side. But when you have a policy divergence like that in terms of monetary policy, it leads to a higher dollar, because the dollar reflects interest rate differentials. That tightens liquidity conditions, and that kind of, you know, puts basically sand in the machinery of how smooth things can operate in the markets. And that's why we've seen this very large gap in terms of performance. So I do think we need China to recover, which may be a 2019 story, but certainly having the U.S. economy, you know, running pretty hot here is a big help for the global economy, given how big the consumer is in the U.S.